Okay, so today we're doing May-June 2020 question paper 13. I think this was a very straightforward question paper. We'll start at the bottom. Question 30 is not relevant. And we start at question 29, not relevant to the new syllabus, that is. So what combination of fiscal and monetary policies is most likely to be effective in the short run for tackling deflation in a closed economy? Okay. So remember that to tackle deflation, we want to use expansionary policy. We want to move AD to the right. So we're going to be looking for expansionary fiscal measures or expansionary monetary measures. Now, when it comes to expansionary fiscal policy, that is always increasing a budget deficit because it's increasing government expenditure and it is decreasing government revenue through reducing tax rates. And then we're left with either decreasing the interest rate, that is an expansionary monetary policy designed to make it easier for people to borrow money, to increase consumption and to increase investment. Decreasing the money supply, however, is a contractionary monetary policy designed to decrease consumption, investment, etc. and move AD to the left. So because we're trying to tackle the deflation, we're going to use both measures that are expansionary, and therefore C will be the correct answer. Question 28. What would be a positive effect on the growth of the economy in the short run if a government reduces a direct tax on individual earnings? Okay, so the first thing is you need to think about the effect of reducing a direct tax on earnings. What that's going to do is it's going to provide more disposable income for individuals. So food prices would increase due to shortages. That would be incorrect. There's nothing linking the possibility of a shortage happening due to food just because we reduce direct taxes. Import of luxury cars would increase to satisfy a change in demand. Okay, maybe that's possible, but it's not going to have a direct effect on the growth of the economy in the short run. Remember, if we import more, that would actually decrease the growth of our domestic economy because it would move our aggregate demand curve to the left. So we want to be looking to move aggregate demand to the right in order to have an increase in the growth of the economy. Savings would increase due to additional disposable income. Again, maybe that is true. Maybe they're pessimistic about the future, so they decide to save more. But again, it's not going to have a positive impact on the growth. We want them to be able to spend more on the domestic economy to have a positive impact on the growth of the economy. So, therefore, consumption of domestically produced goods will increase. That will have a positive impact because it means that we're going to spend more on the domestically produced goods, using the increase in disposable income that we've got or we've received from the fact that the government has reduced the direct taxation on our income tax. Question 27. Why is a balance of payments deficit a potential problem for an economy with a fixed exchange rate? Okay, so remember what a fixed exchange rate is. It's the government essentially controlling that exchange rate. Right, and there's one thing that's of critical importance or main importance for a fixed exchange rate, and that is the level of foreign reserves that the central bank or the government can hold. So essentially this would be what would be problematic with a balance of payments deficit, because the increase in the imports will result in our foreign exchange reserves decreasing. Nothing to do with domestic money supply. Nothing to do with rival economies react with trade protection measures, and nothing to do with short-run standard of living. Only the impact on foreign reserves will impact our ability to maintain the exchange rate at the level that we want when we have a fixed exchange. So remember, it's that there is still elements of market forces or demand and supply, but the governments essentially use their reserves or their foreign reserves to dictate the exchange rate back to the level that they want it to be. So even if they have, let's say, rival economies who are reacting with trade protection measures, if they have enough foreign reserves in their holdings, they'll be able to either sell or release their supply, whatever it happens to be, to dictate that exchange rate back to where they want it to be. 26. An economy with a long history of extensive barriers to trade decides to switch to totally free trade. What is most likely to increase in the short term? Okay, government revenue might increase in the long term. Okay, but that would be due to a growth in the economy, not necessarily a growth from revenue generated from imports, for example. So that will definitely be a long-term effect. Maybe that's because of economic growth and we'll be able to collect more in income tax in the future. Inflationary pressure will definitely not increase in the short run. It should decrease because we're not having any restrictions on the prices with any protectionism measures. So prices should be lower for consumers. And profits of all domestic companies, again, that's a generic statement to say that all domestic companies will increase their profit in the short run. Again, that may be possible in the long run or the very long run as we get to reap the rewards or the benefits from the free trade. But also that will depend on the efficiency of our domestic companies. Can they remain competitive in what is now a hyper-competitive environment with free trade? What is likely to increase in the short run is the consumer surplus. And the reason for that is that the prices of the product should now be lower. And if we know what our definition of a consumer surplus is, it's the area above the equilibrium price to the top of the demand curve. So if we have lower prices, that will equal the consumer surplus increasing or consumers receiving a greater surplus. '25 should be very straightforward. Real national income of a country fell by 3%. What could have caused this? So if money national income falls by 3, that is minus 3 essentially. And we always remember when the rate of inflation is positive, we always have to take it away. So minus 3 minus 6 for A would give us real national income would actually fall by minus 9%. That would be the exact same for B because it would be money income minus 6 minus the rate of inflation, which is 3. Money income rose by 3, so that would be plus 3 minus the rate of inflation, which is 6, and that will give us real national income minus 3%, so that would be the correct answer, C. And money income plus 6 minus the rate of inflation, 3, and that would be plus 3% real national income, but we're told that it has fallen by 3%. So C is our correct answer there. Question 24 is calculating country's balance of payments. These are the 4 components that we have in the balance of payments, and really it's very simple. We take our exports away from our imports, we're left with a balance, and then we add up the 4 balances from the 4 components of the current account. The balance of trade in goods, the balance of trade in services, the primary income balance, and the secondary income balance. So the balance of trade in goods here would be 150 minus 200, which is minus 50. We're dealing in billions here, remember. So we'll put that up the top, BN. 70 minus 50 will give us a value of plus 20. 120 minus 100, again, plus 20. And then 15 minus 20 is minus 5. So that will be minus 55 plus 40, which will give us minus 15 billion as a current account deficit. And we can see that matches up with B. Okay, question 23, terms of trade index. What statement about the period is correct? So first of all, remember, terms of trade index is the index of export prices over the index of import prices. Okay, so it's only relating to the prices of exports and imports. It's not relating to the volume, etc., or anything like that. So general level of prices is not affected, it's only exports and imports. Volume is not affected, it's only the prices. Export prices have increased, so because of the formula here, the export prices increasing would result in the terms of trade being greater than 100, like 101 for example in the following year. So that clearly hasn't happened, so that has to be incorrect. Terms of trade have deteriorated, which is the correct answer, and essentially the way we interpret that is that that means from 2013 to 2015 the import prices must have rose relative to the prices of exports. So essentially the prices of imports, for a deterioration in the terms of trade to happen, they have to rise by more than the price of exports. Or they could fall by more than the price of exports fall. Okay, country operates a floating exchange rate. What will cause the demand curve for the country's currency to shift left in the foreign exchange? So what will cause the demand to drop? And we can see here very simply that would be the first one, which is decreasing the country's interest rate. Cause the demand for our currency to drop because people don't want to put their money into our bank accounts, as they will receive a lower rate of interest on their savings. All of the others here, increase in imports, increase in exports, and decrease in money supply, will not result in a decrease in the demand for our currency. If you want to go through them individually, you can have a look in the foreign exchange chapter of the slides that I've provided in the OneDrive for you all. They go through each scenario and foreign exchange rate factors, how it will change demand, how it will change supply. Interest rate, if it's mentioned, is generally the answer that Cambridge will be looking for. Okay, what will increase if aggregate demand rises when aggregate supply is perfectly elastic? Okay, remember aggregate supply is perfectly elastic in this area here, if I can show you, right? So when it's like a perfectly horizontal line, which means that we've got a lot of spare capacity in the economy. So for aggregate demand, if aggregate demand rises, what will change here is therefore real GDP, which we can see here. If we have aggregate demand at that level of capacity, when it's perfectly elastic and we shift to the right, what is going to change there is going to be our level of real GDP will increase, and our level of real GDP is obviously our level of real output. Question 20. A government decides to devalue the country's currency to remove the deficit on its current account balance of payments. Okay, what is the most likely reason why this would not work? So remember, a devaluation works to reduce the price of exports, which means our total exports should rise, and it works to increase the price of imports, which means that our total imports should fall. Now, it will definitely work if the price elasticities of demand for the country's exports and imports are greater than 1. And that is because, as we've just explained, it changes the price of them. So just like your PED, when the PED of a product is elastic, which is greater than 1, if the price of the product goes down, which it would for exports, then the change in the quantity demanded for exports, if it's elastic, would be a greater percentage change than the change in price, and that would result in our total revenue rising. So, nothing to do with capital and financial accounts. Nothing to do with gaining a competitive advantage from devaluation. So those would all be reasons why they would work. But if there's high trade barriers with the country's main trading partners, then even if the price of our exports drop, it may not be possible that we can increase our export revenue because we may be restricted in the form of, for example, quotas that the other country will impose on our exports. Question 19. Graph shows the annual percentage change in the price of services and in the price of goods between 2007 and 2012. What can be deduced from the graph? On average, the price of services was higher than the price of goods throughout the period. We can't make that assumption from the graph, right? All we're getting is the annual percentage change, price change. We don't know what the actual average price of each one is. Average price of goods was higher in 2012 than 2010. So we can see here that goods is continuously having a negative price change, which means that for each year it remains negative. The average price of those goods is actually dropping. So it's not being higher, it's actually falling. Average price of services was higher in 2012 than 2010. We can see that's true because every year for services the average price is increasing, which means that even if it's increasing by a lower rate, so 2010 here is 6%, 2011 is let's say 7%, so that's a 7% increase on 2010, whereas 2012 here is let's say 5%, that is a 5% increase on 2011. So this is like the rate of the percentage change. And therefore average prices in 2012 will be higher than 2010, and it doesn't tell us anything about general price level, it only tells us goods and services. Question 18. What is an example of direct provision? Remember, direct provision is where the government will directly provide goods and services. So for A and B here, a subsidy is indirect provision. They're only helping to subsidize the production of the good or service. They're not actually providing it themselves. Same with a unit tax. They're not providing a good or service. Same with setting a maximum rent. They're not providing the good or the service. They are providing it if they take over a private library to improve local services. They will now provide the services that are provided by that library. So they will be directly providing them to society. Question 17. In November 2017, the Scottish Government introduced a minimum price for alcohol because of the detrimental health effects of alcohol consumption, which combination of actions is most likely to lead to a failure with respect to reducing the detrimental effects? Okay, so first of all, if a minimum price is too high, that's going to help reduce the consumption of alcohol, because it will result in the higher the minimum price is, the greater the reduction in demand will be for those goods and services. So what will lead to a failure is if the minimum price is too low. And then we're left with the health benefits of reduced alcohol consumption have been overestimated. So that will help lead to a failure in reducing the detrimental effects, because it means that consumers may, for example, still be willing to pay the higher price, even if the minimum price is too low, because they feel like alcohol isn't as bad as the government are telling them it is for their health. Whereas if we have stricter enforcement of the regulations, that is going to make it harder for them to purchase or to be able to buy alcohol. So that would actually help us to reduce the detrimental effects and to reduce consumption. Okay, diagram shows the market for eye tests. Which policy would the government, or would enable the government to increase the number of tests from OQ1 to OQ2? Okay, to increase from here to here. Maximum price of OP3, that's above equilibrium. Maximum price has to be below equilibrium, so ineffective. Minimum price of OP2, that is in equilibrium. Minimum price has to be above equilibrium, so that would be ineffective. Subsidy paid to opticians of P3 to P2, or a subsidy paid to opticians of P3 to P1. Okay, so this comes down to essentially how we know about the calculation of the area of the subsidy, right? So essentially, if we want to get to Q2, we want to have a new supply here, right? And we know to calculate the total incidence or the total area of that subsidy, we need to take from the new supply curve up to the original and take it across, right? So we can see therefore that the total area of the subsidy needed would be from P3 down to P1, right? So a subsidy paid to opticians of P3 to P1 per test, that total area of the subsidy would shift our supply curve onto this point, and then we would be able to have the quantity, the number of eye tests now being OQ2, which is what the government was trying to achieve. Okay, question 15. Very similar to the last one. The only difference is, so first of all, the total area of the subsidy is the exact same. It is this area from new supply up to original. Take it across and take it across. The only difference is now we're splitting it between the consumer and the producer. So both the producer and the consumer are going to receive a benefit from this subsidy. The benefit that the consumer is going to receive is essentially the price they used to pay, which is here at H, down to the price they're now paying, which is K, right? So the area or the benefit of the subsidy for the consumer is always the difference between the price that they used to pay to the price that they are now paying. And essentially, any area that is left over is the benefit to the producer, which is what the producer gets to pocket from the subsidy. So how do you calculate it? You take the difference between the old price and the new price, and that's always benefit for consumer, and whatever is left over, once you follow the idea of taking the new supply up to original and across, whatever area is left will be the benefit for the producer. So in this case, we can see benefit for consumer is P1, P2, J, K. And that should be B is the correct answer. Okay, question 14. What is most likely to occur when the government privatizes public sector organizations? Okay, simple. That will be consumer choice will increase. Because once they privatize it, competition will occur within the private sector, and that will result in more choices, more products available for consumers. Employment will increase in short run. Employment is likely to decrease because private sector is going to be looking for lowering their cost of production and becoming more efficient. So they may get rid of inefficient employees from the government organization. Innovation will be encouraged because there'll be more competition, and production of public goods will increase. That is definitely not going to happen. Remember, private sector doesn't provide public goods because they're non-excludable, non-rivalrous, and they can't charge a price for them. Okay, question 13 is a PED determinants question. So what makes price highly elastic, which is greater than 1.00? First of all, the more substitutes they have, the more elastic they are. And that's because, remember, elastic means that their demand is highly responsive to a change in price. So the more substitutes they have, the easier it is for consumers to switch away. Therefore, they are more responsive to any changes in the price of their products. Similarly, if you spend a large proportion of your income on a product, it's more likely to be an elastic PED, because you are more likely to be responsive to a change in the price of that. The example that's provided in the book would be, you might have a different individual PED for two products. Your PED for coffee, for example, you might spend a small proportion of your income on that product. So even if the price of coffee rises by 10%, you may still feel that it's not having a detrimental or highly detrimental effect on your disposable income to pay the extra 10%. Whereas when it comes to the price of a plane ticket to travel across the world, any percentage change in the price of that is likely to dramatically affect your demand for that product, because you're going to be spending more of your income on that product. Question 12. It's simple if you can read the table correctly. So we're given the elasticity with respect to the price of bus travel and rail travel. And we're asked, what would be the change in the volume resulting from a 1% increase in bus fares? What would be the change in volume for rail travel? Okay, so we need to take rail travel here, because this is the XED formula we're using. We're calculating the change in volume for rail travel, and we need to take it with bus travel here. So the figure we're going to be looking at is plus 0.16. Okay, so formula is percentage change in quantity demanded, in this case of rail travel, divided by the percentage change in price of bus fares or bus travel. So we know that the XED is 0.6, which means that essentially it is X, which we don't know, the change in quantity of rail travel, over plus 1% equals plus 0.16. Okay, so therefore very simply we know that there has to be, because it's a plus figure, an increase of 0.16% in the volume of rail travel. Question 11. Very simple. All we need to do here is input our supply into the equation. So when the supply is $1, or when the price is $1, supply equals 10 plus 10 multiplied by 1, which equals 20. When the supply is $2, it equals 10 plus 10 multiplied by 2, which equals 30. Okay, so price of the product when it moves from $1 to $2, price is changing by 100%. The quantity supplied, however, is changing by 20 to 30, which is 10 over 20 is the change, which is 50%. And then if you know the formula is percentage change in quantity supplied divided by percentage change in price. So it's 50% over 100%, which will equal 0.5. Okay, question 10. Which combination of the classification of a good and market change will cause the demand curve for the good to shift to the right? So what's going to cause demand shift right? Okay. So first of all, anything that says price increases is not going to apply. Remember that they cause extensions and contractions, not shifts. For a normal good, if income decreases, price or demand curve will shift left. It has a positive relationship with income, which means income goes down, demand goes down. Inferior goods, however, have an inverse relationship. So if income decreases because they're low quality and generally cheaper products, the demand curve will shift to the right and people will purchase more of them. Okay, question 9. Diesel engines are a major cause of air pollution in cities. A city authority placed a charge on diesel taxis entering the city. What is the most likely effects on demand and supply? Okay. So, very simply, what must have happened here is that they have put basically an indirect tax on the product, right? So we know the supply curve should have shifted to the left. And therefore what we can see happens is we can see a contraction in demand, which is a fall in the quantity demanded, and we can see a shift in the supply curve to the left, which is a fall in the supply of taxi journeys too. Okay, equilibrium price of a product is $10. The government introduces an effective minimum price of $12 for the product. Under which condition will the value of the producer surplus increase the most? Okay, so remember that the producer surplus is to do with, it's calculated as the area below the equilibrium price to the bottom of the supply curve. So if we put they said minimum price, right? Yeah. Minimum price, we'll just show it here. Now I'm drawing demand if it is unitary, let's say. Okay, so producer surplus would have previously been this area in here, which is the area I'm running through with my pen now. Once we impose the minimum price, that changes, right? So the producer surplus now becomes area below equilibrium price to the bottom of the supply curve, which means that it becomes this total area in here. So therefore, if you look at the curve, you could see that should PED be 0 or be perfectly inelastic like so, what that would do is that would actually create the greatest producer surplus, sorry. So if the PED of the product is 0, we will have the value of the producer surplus increasing by the most. Okay, question 7. Diagram shows 2 demand curves and 2 supply curves. Which equilibrium point is most likely to represent long-run equilibrium? Okay, so this is based on your understanding of PED and PES. Okay, and it's to do with the time period for both. So first of all, we can see in this one here and this one here, they are highly inelastic. Okay. Now that could take place over the short run. They could have an inelastic PES and an inelastic PED. But in the second diagrams here, they are elastic. And that will only take place over the long run. Okay, so what happens is, remember, the time period is something that affects PED and PES. And for both of them, the longer the time period, the more elastic their values become. Which is why both of these demand and supply diagrams here look closer to horizontal than they would here, where they look closer to vertical, representing the fact that they're more inelastic. So therefore, equilibrium in the long run of the market should be where demand and supply with elastic PES and elastic PED are intersecting, which should be point B. Okay, question 6. What is most likely to increase the quantity of houses supplied? Okay, a policy to help house buyers on modest incomes. That will definitely help to increase the quantity of houses supplied, because what that will do is it will result in an extension in supply and an increase in demand. So if we use that policy, we would have demand for those modest house income earners increase, and we would have an extension or an increase in the supply of houses. Okay, restriction on the level of rent that can be charged would definitely not, because then homeowners or people who want to buy the houses would not be able to obtain as much profit, so they might invest into other areas instead. A rise in the tax on materials would shift the supply of houses to the left. It would increase their cost of production, and therefore it would decrease the quantity supplied. And the same with a removal of a subsidy to house builders. That would shift the supply curve to the left, increase their cost of production, and mean that they would supply less houses. Question 5. In a free market, there is a surplus of a good. What change would cause the market to come to equilibrium? Okay, so surplus, remember, is where we're somewhere up here, which means that we've got, I'm not going to draw the full diagram, just going to give you an outline, which means that we've got a higher level of supply than demand. So this would be a surplus. Okay. Now what has to happen is that because we've got an excess level of supply, the price mechanism is going to go to work here, and it's going to signal that what we need to do is we need to decrease the price of the product, because we're producing more than we can actually sell in relation to demand. So we've got to decrease the price of the product in order to get back into equilibrium. And therefore the change to get back to equilibrium would be a fall in the price. A decrease in demand would just extend the surplus. A minimum price is not a change that would cause an equilibrium. It would cause either a higher surplus, or it could be the reason why we have the surplus. And an increase in supply again would cause a further increase in the surplus, a further movement away in terms of how much supply we have from the level of demand we have. Okay, question 4. What is a normative statement? So remember, normative is objective, opinion-based. Sorry, not objective. It is subjective, an opinion-based statement that cannot be tested. If interest rates fall, consumption is likely to increase. That is a positive statement. We can test it. Factual. If interest rates fall, consumption will definitely increase. Again, positive statement. Look at the language that's used. We can test that statement. Interest rates and consumption are usually inversely related. So again, positive statement, hypothesis that can be tested. Whereas the normative statement here would be the rate of interest should be reduced. You can see it in the language there by saying should be. It's an opinion, it's a statement that's put forward. We can't test the statement, and we don't have any other comparison to test it against, unlike what will happen if interest rates drop to consumption, or what will happen if interest rates rise against consumption, which is something we can test out that relationship with. Question 3. What type of good is healthcare? Very straightforward. Healthcare and education, remember, are the two ones they always bring up in AS economics. And they are, if you get the question, they are private goods, because they are not non-excludable and non-rivalrous, but they are also merit goods, because they generate external benefits for society, which means they are underconsumed and underproduced. Okay, question 2 is a question on liquid assets. So remember, liquid assets mean that they can be converted to cash, or they're already held in cash. So his salary is not a liquid asset. House is not a liquid asset. And his shares are not a liquid asset either, because they're not currently held. They're not cash that he can use. His current bank balance and the money in his wallet is a liquid asset. It's cash that he has. And the jar in his house, which is containing $100, would also be a liquid asset, cash that he has available to spend right now. So 15 plus 200 plus 100 would give us $1,800 as the value of his liquid assets. And finally, question 1. An economist knows the current point at which an economy is operating within its PPC. What can the economist judge from this knowledge about the economy? PPC doesn't tell us anything about its level of self-sufficiency, or its international competitiveness, or its rate of economic growth if we are within the PPC, but it does tell us the level of output of two goods. So remember that for a PPC you have good A and good B, and the definition of a PPC is that it shows the productive possibility or the production potential of two goods in an economy with a given set or the current set of resources and technology available. So all we can know from judging where we are within the PPC is how much we can produce of good A and how much we can produce of good B. Okay, and that is May-June 2020, question paper 13 done.